Hello everyone, welcome back to the Road to Retiring channel. Hope you are doing well. As you can see on the screen, we're looking at Fabrinet today, and it has some seriously impressive increase in price over recent years. You can see this is 2015. We look at the price from 2015 all the way to now. You can see it's up around 600%, and if we look into January, it was up around 770%. Now, you can see it's fallen down quite a bit since January, and I wanted to see if it was at a discount now or a price worth buying. So, what is Fabrinet? Well, it engages in the provision of optical packaging and electronic manufacturing services to original equipment manufacturers. Its manufacturing operations offer sensors, subsystems, customized optics, and optical modules and components. It's in the electronic technology industry. If you do want to find out a bit more about the company itself, then go do a bit more research, but I want to go into the financials because the financials are incredible. So if we have a look, first of all, just look at the analyst rating. Strong buy, 1 year price target, 33% upside at $147.80. So that's really good to see that the analysts are liking it. But I want to go into the financials and why I love this so much. So, you know, for me, there are 4 things I like to see having consistent growth in. That's earnings, revenue, operational cash flow, and equity. If we look at earnings and revenue, you can see that both of these have climbed massively from 2015 to 2022. Revenue up around 3 times what it was in 2015, and earnings around 4 times what they were in 2015. So both of those growing amazingly, and you can see the future forecast for this is continued growth, which is also really good to see. Now, on top of this amazing growth in earnings and revenue, they have this in cash from operating activities, as we see here, was 47 million in 2016. Now it's nearly quadruple that at 171 million currently at trading 12 months. So again, operational cash flow is up massively. And if we look at the equity, this again is up over double from 550 million in 2016 to 1.25 billion in 2022. So the historic growth rates in all of these metrics are amazing. And if we have a look at the overview quickly of the stock, you can see that the profit margins are growing really nicely. The general trend with this was this orange line on the screen here. You can see this is going up greatly and the profit margins are climbing, so that's great to see. You can see here revenues going up at a nice trend, earnings up at a nice trend. And if we look at the financial health, it's really healthy. You can see they have currently in 2022, or they had in 2022, 198 million in cash, 30 million in debt, and 34 million in free cash flow. So their debt was less than their free cash flow, and their cash could pay off their debt about 5 times, or even more, 6 times. So they have cash and free cash flow towering over their debt. And in terms of assets over liabilities, in the short term, they have about 3 times as many assets as liabilities, and in the long term, they have about 8 times as many assets compared to liabilities. So just great financial health with this company. And once again, I just want to show you, look at this price chart. Look how much it's grown from 2015. Consistently, it's just up and up. Did have a dip at the end of 2022 in the market, well, start of 2022 into sort of halfway through around June time. It fell quite a lot, and then it's climbed up again massively from those lows in June, and now it started to fall again, and hopefully we see a similar pattern where it starts to rise up again. But I think this is one for the long term. If we look at the financials again, the other things I like to see at top of the financial health being great, which we've seen, the long-term debt's fine. If we look at it, 6 million long-term debt, that is so little. And we look at the cash flow, 110 million over trading 12 months. They just have a brilliant financial health. And if we look at the investment in the company, the management, see how they're making their decisions, the return on invested capital is really good. We like to see this around 10% or higher, and you can see this is climbing, and currently it's sitting at 16.6%. So a really nice level on return on invested capital, one where we feel comfortable that the management is making effective decisions. And this has always been above that 10% benchmark that we like to look for. Even at its lows in 2016 and 2018, it was still above that 10% level. So management's making effective decisions, and as you can see, the forecast for it is equally as impressive if we look at the annual growth. I'm going to go into my prices now and what my estimates are. So going over to this sheet, as you can see, it's fallen by 20% over the last couple months. So is it at a good value? Well, earnings growth rate, 8.96%. This is what the analyst 5-year estimate is. The realistic growth rate we think they can achieve is 19.17%. So we're comfortable going with that analyst estimate, as it doesn't seem overly ambitious. We're comfortable at those levels. Going with a discount rate of 9.5% because that's what we want to see each year return on our stock if we invest in it. A margin of safety of 10% because the financial health is so good with this company. There's no alarms ringing anywhere in terms of the balance sheet, so we've gone for quite a low margin of safety. Share dilution, we've gone for 0%. This is because it's pretty much sat around the same total common shares outstanding since 2016. It was 36 million in 2016, went up to 37, back down to 36, and it's just sat around 36 million this whole time. Never really changing too much. As you can see, it's just always been around that level at 36 million. So we put share dilution at 0%, put in that earnings growth rate of 8.96%, EPS estimate of $7.71 in 2023, which you can see here. 2023, $7.71, and with that growth rate taking us to around $9.15 in 2025, so we're slightly undershooting what the analysts are, what the TradingView analysts are estimating. We feel a bit comfortable that we're going below those levels, and we've gone for a price over earnings multiple of 16. Now, as you can see, their current price over earnings 15.72, their 5-year average is 17.32, and the sector median is 18. So I feel pretty comfortable levels at 16. It's not something which is above the sector median or a massive premium where we think it's unrealistic that it's going to trade at these levels, and it's below their 5-year average, so I'm comfortable at those levels at 16. And based on that, we get a fair value of $108.31 with a 2028 price of $189.46. So super close to our buy price right now, only a 2% drop needed, and it may be worth making the gamble buying it now as it's fallen quite a lot. Although the next support levels are quite low, so you might want to keep an eye on it and just make sure you're getting in at the right time. But it's definitely close to those buy levels right now, and it's one that I'm definitely considering picking up. And you can always pick up more if it falls further, if it is one that you're interested in. Now, price over sales, again, we've gone with the revenue estimate of 2023, which is 2,650 million. If you look here, financials, annual, 2023, 2,650 million. Climbing to 3.32 billion in 2025. We've accounted for that, 3.32 billion in 2025 with a 12% revenue growth rate, and we've gone with a price to sales of 1.5. Now you can see it climbed a lot from 2018 to 2022, or the end of 2021, going from really low levels around 0.85 up to 2.1. So really sort of climbing, and it did get a bit high, I think, and it's a level at that time that I wouldn't have felt super comfortable with it. You have seen it started to come back down, and I think it's sort of averaging out around this 1.4, 1.5 level, and you can see the price to sales is 1.64 currently, the 5-year average is 1.5, and the sector median is 2.68, so it definitely feels comfortable at those levels. And I've gone for that 1.5 price to sales multiple, and again it's very similar, it's just above the current price. Another 2.3% drop needed from the current price, and it will be at our buy value, with our fair value being $108.24, a 2028 price of $189.33. And lastly, looking at the cash flow, but quite a high growth rate here because it's actually the cash flow is actually under what their net income is right now, and that's because they have quite a large amount of changes in working capital. If we have a look at the cash from operating activities, you can see despite the funds from operations climbing really nicely and being at levels at 306 million, the cash from operating activities are only 170 million. Now this is because their changes in working capital are quite high at minus 145 million, though these changes in working capital are never usually particularly consistent. However, they seem to be quite consistently in the negatives with Fabrinet, so I've gone for the cash from operating activities to trade at a level below the net income at 345 million in 2027, with the net income trading at 438, about nearly 100 million under what their net income would be, and that feels reasonable considering the net income currently is let's have a look, 234 million, and their cash from operating activities is 60 million below this. So I think we have like a similar relationship between the two, and we'll just have that cash from operating activities expectation slightly below what the net income is. So I've gone for that 345 million. And based on that, we've used a cash multiple of 20. This is the Fabrinet 5-year average at 20.23, and it's also really in line with the sector median at 19.79. So that feels like a super comfortable level that the stock seems to be trading at consistently, and feels like a level it will continue to trade at. So I've gone for 20 as a price over operating cash flow multiple, and again it paints another similar picture. A fair value of $106.77, meaning that it needs to drop 3.65% to reach these levels, and a 2028 price of $186.76. So when you take the average of all of these, they're all pretty similar, and we get a fair value average of $107.78. So only a 2.75% price drop needed for it to be at our buy levels. So it definitely could be worth considering now, considering it has dropped over 20% already. But you may want to keep watching it, see if it continues to drop further, and maybe this could be one to add to your watch list, investigate a bit further, and potentially add. As you can see, the growth rates historically have been absolutely fantastic with this company, up from the start in 2010 to now, up around 1000%, and it was up as high as 1250%. So just incredible growth rates with Fabrinet, and it's one I am very, very interested in, and definitely will be looking to add to my portfolio if we see it drop just that other extra 2%, and I may even consider adding it now before it even hits those levels. And then if it does fall further, then I'll just buy more, as I think it's such a great stock. But guys, let me know what you think about Fabrinet. Is it a stock that you're interested in? Do you think it looks like one that you're going to add to your watch list? And if not, let me know why. But guys, please like the video if you enjoyed, subscribe if you want more kind of videos like this, and drop a comment for any other stocks that you're interested in hearing about. But now, it's been Road to Retiring. I'll catch you in the next one. Bye guys.